Welcome back to my channel. In this video, I'm going to be covering DoorDash. This is a new economy company that allows people to have food delivered to their homes. And now they are branching out to other types of products, whether you want something from the grocery store or a package delivered. But they primarily serve restaurants, and they've been very successful. The company's been growing really well. They're profitable and generate free cash flow, which is the reason why I started investing in them over a year ago. It's gone well to this point. They had an earnings call and their stock really tumbled. I wanted to take a look at their earnings and see where the problem lies. What is the big concern? I've been holding on DoorDash stock because the stock had run up so much that the stock price is above the value I had previously. I want to recalculate the value that I have for DoorDash and see if now the price has come down and the price is discounted. We'll take a look at that, and I'll make my decision whether I want to buy more shares of DoorDash, hold, or sell my shares. Before I jump into that, just remember that I am sharing my individual investor journey. I am not recommending you buy or sell DoorDash, and I am not providing financial advice. I'm just providing my experience, and I hope you find it interesting. DoorDash is competing with Uber Eats and a couple of other players here in the US for the market share around delivery of food and now delivery of other products. We have really changed as an economy where, we used to go to the store and buy things, and that is really changing. It has become so convenient to have food delivered and to get our products delivered. What DoorDash is also doing is they sell a subscription where you pay a monthly fee and you get unlimited deliveries to your home, which could be quite lucrative. If you think about what you could save, gasoline, maybe you don't even want to have a car. You can have all these things delivered for $10. That seems like a pretty good deal if you get, 5 to 20 deliveries a month, delivered to your home. So it's really changing the way that we consume restaurant food, our groceries, and so forth. Really exciting. This has been a high growing stock. They continue to grow, which is really good. I'll take a look at their financials and I'll look at their earnings to make sure that the earnings is going to continue, which is a big factor in valuing this company. Overall, I think it's a really good company, run really well by a strong CEO and his team. And I think they are really persistent on trying to get better efficiently. And that's really going to drive better profitability, which is very good. I also like that they're growing and branching out to other types of products that could be delivered. The restaurants, I think that market space has maybe been tapped into enough. There might be a little bit of growth left there, but I think they can grow in other areas. I think grocery stands to really be a good growth area because, frankly, we need groceries every week. And it's nice to have, especially if you get the subscription to DoorDash, you can have a few items delivered every couple of days, make it really convenient for yourself. So overall, I really like the business. I like the management team, and I'd like to take a look at the fundamentals next. So DoorDash is a $46.9 billion company. That's a pretty good market cap for this company. They're a young company, but they're in the right space. The revenue is $9 billion, pretty good revenue, and you're paying, upwards of 7 times revenue for the company. That's a pretty good price because this is a growth company. So it's not priced as expensive as other companies that are growing. Their forward P is really high, frankly, because their earnings per share is really anemic. This company has a lot of stock-based compensation to its employees, and the reporting rules require it to put it on its income statement. Although it's not a expense where they're writing out checks, they're just issuing out stock. So it really affects earnings per share. Now, we could probably start a good argument around stock-based compensation. Some people think it's just terrible. I happen to think that it's a good thing. You're making employees that are really important to the company part owners of the business, and likely will be working that much harder, that much more intensely to make DoorDash successful. So I'm actually in favor of stock-based compensation and don't think it's an evil thing. I think it's a good thing. And you're not consuming cash that the company has. So if you're not consuming cash, you can use that cash to grow the business. So that's where I stand on stock-based compensation. But when we look at earnings per share, you're going to see that the number is rather low compared to their free cash flows. Now, a lot of analysts cover DoorDash, and in general, they have a price target that's 7% higher than the current stock price. So it shows that there's a small discount available potentially based on analyst expectations. The stock has been going up for the past year. It's up 81%, but recently it's down quite a bit. In the last month, it's down 19.6%. So this dip, does it represent a good opportunity or maybe just taking some of the froth off of this stock? Well, we'll take a look at my valuation and I'll give you my opinion of where the stock ought to be priced. Revenue growth for DoorDash has been excellent. If you look at the last 5 years, just tremendous growth in 19, 20, 21, and it started to slow down. That's just the law of big numbers. As you get bigger, it's harder to grow and make that big percentage because they went from being less than $1 billion company up to now a $9 billion company. So their growth is the percentage has been going down, but the amount of revenue has been going up, which is very good. Just very good growth rate from DoorDash, which is one of the reasons why the stock was really working for the past year. DoorDash is in a business where they generate free cash flow, and that's great. That's why the company is worth what they're worth, is that the operating cash flow has been going up over time very nicely, and they don't have to spend a tremendous amount of capital expenditures to grow the business and keep the business operating. That said, they have really good free cash flow that I'm going to use to value the company, and it's been growing tremendously. So that's a very good combination. And I believe that's one of the principal reasons why the stock price and the market cap of this company is as high as it is for a very young company. 28 analysts cover DoorDash, and collectively they put a buy rating on this stock and believe that the stock ought to be priced 7% higher than where it's at now. The top end of the analyst believe that the stock's worth $170 per share, and the most pessimistic analyst believes the stock's only worth $51 a share. So it's pretty wide dispersion of analyst reports. I'm going to take a look at my own valuation, but again, a lot of analysts cover DoorDash, and no stone is left unturned on this company. The earnings per share is where we hit a wall with this stock. And the reason for it is their earnings per share in 2024 is really low. It's only 20 cents a share. So that's really going to calculate a super low value for this stock. I'm going to use 2025's number and then bring down the PE ratio just to, value the company based on its future. Its future looks really bright. If they can hit, the 25, 26, 27 numbers, the stock will have a really nice earnings per share within the next 3 years. But for now, this year, the earnings per share is really low. DoorDash announced their earnings on May 1st, I believe after the market closed, and the stock really went down, which was, I guess, understandable because the CEO really downplayed and felt that they could have done better. Other companies that have been really good performing stocks, like Meta is known for this, is they have a really good earnings and then they just, pour cold water on it. I think part of it is that DoorDash stock is up so much that the CEO has, the room to kind of pour cold water on their earnings so that investors don't get too enthusiastic about the stock and really run up the stock. He basically maybe set up the company to outperform the expectations going forward and just keep, the upward momentum going. That's me speaking. That's my imagination working, but that's what I'm observing. Overall, their earnings I thought were positive. The company grew their total orders by 21%. That's really good. And if you look at the overall amount of restaurant food they're delivering, that's really gone up by 21%. So excellent. Now their orders went up by 21%, but the revenue went up by 23%, which means their prices are going up. And I think that subscription model is beginning to work. So two really good things out of the top line revenue of DoorDash. Looking closer at their operations, the total orders went up 21%, just really good growth quarter over quarter. And they're comparing this year's first quarter compared to last year's first quarter. And that's just very good growth. Again, the value of what they're selling has really gone up 21%. And then revenue's gone up. Their profit is increasing. Very good. So it's important that not only are they growing the top line, but they're actually growing their profitability. Really important. Very good to see. Their EBITDA keeps growing. And EBITDA I use to make a judgment call on their balance sheet. But their balance sheet's excellent because they have zero debt and they have $4 billion cash and they have positive EBITDA. So overall, their balance sheet's in such good condition that they could operate for a long time without ever having the big fear of bankruptcy. The company provided forward guidance, and the guidance is very good. They're going to keep growing pretty much at the low 20% growth rate that they've been experiencing, providing positive EBITDA growth. Those things look really good. The stock-based compensation continues to be one of the areas of big expense. And again, I shared my views on stock-based compensation. It's actually a good thing. If you look at some of the most valuable companies, you'd be amazed at what they pay their CEOs. They pay them over their career, geez, over $1 billion if you look at like a Microsoft or an Alphabet. So it's really, I think, a good thing when you make the key employees part owners in the business. We'll see how that plays out. I'm sure over time, as they need to hire more people, that ratio will go down. So, what do I think DoorDash is worth? Well, let me do the calculations and share that with you, and then tell you where I think the stock ought to be priced compared to their current stock price. So, first, I'm going to value the company based on free cash flows. And the company generated really good free cash flows. They've been growing really well. So, I'm actually going to take the cash flows from 2023 and increase them by 15% as my starting point as cash flow. And then I expect that in the first 4 years, it's going to grow at 15%. And then after the first 4 years, I'll be conservative and say they're going to grow at 4%. That'll set up all the cash flows after year 4. I'm going to discount the stock by 9%. This is a dynamic, somewhat small company, so it's a little bit higher than I would have used for Meta or Alphabet, very established companies. When I discount all those cash flows I expect in the future by 9%, I get a net present value of $43.7 billion. That's what the company cash flows are worth. And I add the cash, they have zero debt. So it actually increases the equity value of the company. And compared to their current market cap, it's, I would say, fairly priced. The current market cap is 45.6 billion, and it provides about a 3% discount. I'd rather call it fairly priced. Earnings per share, I'm going to use 2025's numbers because 20 cents per share would have created just a huge premium in this calculation. I am going to limit the PE. I think the PE should be higher than 24, but since I am using 25's figures, I'm going to use a 24 PE. The growth rate's really dynamic on earnings per share. It's going to grow at 20% after the 138 earnings per share figure in 2025. That drives the stock value of $39.74, but the current stock price is $113.97. So there's about a 65% premium if you look at the earnings per share value of this stock. Combined, and I put more weight on the free cash flow method, it's a 20% premium on DoorDash. So the stock has run up over the past year, and I think this business is a real good one. I think they just need to grow their earnings per share, and the stock will continue to be more valuable. They also really need to continue to diversify their business and really have a market share that they can defend and really continue to grow. They have some pretty good competition. Uber would like to replace them, and Uber is a pretty strong competitor. So we'll see if DoorDash can outmaneuver Uber, because Uber is principally a ride-sharing company. I think DoorDash, this is their focus. This is their backyard. We'll see how competitive they can be over the next couple of years. So should I buy, hold, or sell DoorDash stock? I'm going to look at three things. First, the company, second, the balance sheet, and third, the discount. With regard to the company, I just think the company is excellent. I think it's a company that was created by a new generation of entrepreneurs, created really well, very sound business. Technology is excellent. I think they have room to grow. Operated by an excellent management team. Their CEO is excellent. So overall, I really like the management team. I like the business. I like how profitable this business is. I like how much cash this business generates. The most valuable companies create a lot of free cash. You look at the top 6 companies on the stock market, they all generate tremendous high cash flow. And DoorDash generates high cash flow. So they're at a current market cap. I think they could really expand that market cap in the future. The balance sheet. Well, when you have zero debt, you automatically look good on the balance sheet. And I don't see any other liabilities that would worry me. They're in a really good spot where they have a very good balance sheet, plenty of cash, and are growing their business. They can grow with the cash they have on hand and the free cash that they generate. They don't have any need to, go out and get debt. Maybe someday in the future, they may need to do that. But at this time, the balance sheet is excellent. Discount. There's no discount on DoorDash. There's a 20% premium. And I already own a fairly good position of DoorDash. I'll share that with you after I make my conclusion. But I think I'm good with just holding my shares of DoorDash and just waiting to see how their business develops further and then making a decision on whether I should continue to hold, buy more shares, or sell my shares. There's been some companies where I have regretted selling too early after making a good gain. Probably the most recent one is Amazon. I owned Amazon. I sold it in late 23. I felt like the stock had become too expensive, and I was looking at that market cap, and it was getting really high, and I did sell. I probably sold at a price that has appreciated since then by about at least 20%, maybe 30. So I missed out on that additional gain, and that's a lesson learned that investing in great companies is a long-term mission, and at times a good company will be sold at a premium. It doesn't mean I have to sell. In some cases, I'm really glad that I sold. TSM is another example. I sold TSM pretty much near their high that happened a few years ago, and then the stock tanked. So that scenario did work. I felt that TSM was being traded above their value, and I'm glad that I sold it because I had a big position at the time, made a big gain, and then the stock went down more than 70%. So I'm glad that I'm keeping DoorDash, but we'll be continuing to evaluate it twice a quarter and then making my decisions going forward. My investment in DoorDash was $6,897, and the current value of my stock is $8,672. So the total gain unrealized is $1,775, representing about a yield of 26%. This is a little over a year of holding this stock. I started investing in it in early 2023. So overall, I'm very happy with the stock. It's done. It's appreciated really well, and I think it's an exciting company that's worth keeping in my portfolio. Hey, thank you for watching my video on DoorDash. I hope you found it interesting. Please leave a comment. Love to hear what you think of DoorDash and what you think about their future prospects and any other comments you have on this company. Thanks again for watching.